Deciding how much to invest in an annuity this August could be one of the most important financial moves you make, especially given the rapidly changing retirement landscape. But here's where it gets controversial. With interest rates still relatively high, yet expected to drop soon, locking in income through an annuity might seem smart now. Yet some argue it limits your financial flexibility in the long run. So, how do you strike the right balance? Let's break it down in a way that's easy to understand. Angelica Leicht, a seasoned expert in personal finance writing for CBSNews.com, highlights how today's economic conditions make annuities an exceptionally compelling option. While interest rates have dipped from their recent peaks, you're still offering some of the strongest annuity returns we've seen in years. At the same time, inflation remains stubbornly high, and financial markets fluctuate unpredictably. This combination is prompting many retirees and those nearing retirement to seriously consider establishing a dependable, lifelong income stream, something annuities can provide uniquely well. Adding urgency to this decision is the widespread expectation that the Federal Reserve will likely lower interest rates before the end of this year or early next year. Since annuity payouts largely depend on current interest rates, locking in a contract now could mean securing better income than in the future. If you've built up even a modest nest egg, you face not just whether buying an annuity is wise, but also how much to invest without sacrificing your ability to adapt to changing financial needs. However, determining the right investment amount isn't as simple as applying a generic rule. Personal factors like your age, health, anticipated expenses, and existing guaranteed income sources all play vital roles. Add to that the complexities of today's market, and the decision becomes even more nuanced. For instance, your age matters a great deal. If you're in your 50s and still years away from retirement, financial advisors often suggest committing about 10% to 20% of your portfolio to annuities. This approach preserves room for growth investments that could build wealth over time. On the flip side, if you're already retired, or close to it, you might benefit from allocating a significantly larger portion, perhaps between 30% and 50%, to ensure steady income that covers your essential costs. Another critical consideration is your current guaranteed income, like Social Security benefits, pensions, or other reliable payments. By subtracting these from your monthly expenses, you identify the income gap that an annuity can fill. Financial experts commonly recommend that guaranteed income sources cover about 70% to 80% of your essential expenses. This benchmark helps clarify how much annuity investment is reasonable for your situation. Your personal tolerance for risk should also guide your decision. If stock market volatility makes you uneasy, it might be worth embracing a higher annuity allocation to secure peace of mind, even if it means missing out on potentially higher returns from riskier assets. Conversely, if you're comfortable navigating market swings and have a long horizon before tapping into retirement funds, keeping your annuity percentage lower could give you more growth potential. Health status and family longevity patterns add another layer to the picture. If you expect to live a notably long life, annuities become especially valuable, offering a safeguard against running out of money. In fact, a family history of longevity might justify dedicating 30% to 40% or more of your portfolio to annuities to secure lifetime income stability. Market timing is yet another factor to weigh carefully. Today's relatively high interest rates mean annuities purchased now come with better payout rates. However, some investors prefer to dollar cost average by investing gradually over time, rather than committing a large lump sum all at once. Additionally, depending on your personal retirement timeline, you might decide between immediate annuities, which start paying out right away, and deferred annuities, which delay payments but can potentially offer higher returns later. Why might annuities be a smart choice this August? Because they promise stability in an unstable world. Inflation's persistence and the market's ongoing unpredictability mean a guaranteed fixed income can provide invaluable peace of mind. Locking in a higher payout now could protect your buying power and income against future downturns in interest rates. There's also a tax benefit to annuities worth mentioning. The earnings typically grow tax-deferred, meaning you don't pay taxes on the gains until you begin withdrawals. This can prove especially advantageous if you anticipate being in a lower tax bracket after retiring. And for those worried about outliving their savings, annuities with lifetime income riders guarantee payments for as long as you live. A unique security few other investments can match. The bottom line, the appropriate amount to dedicate to annuities this August depends heavily on your personal financial picture, from income needs and risk appetite to health and retirement timing. Most experts recommend considering annuities for somewhere between 20% and 50% of your portfolio, tailored to your specific circumstances. Instead of hunting for a fixed right percentage, focus first on securing your essential expenses with guaranteed income. Then work annuity investments into your broader plan. So, what do you think? Is now the perfect moment to lock in steady income with an annuity? Or should retirees be cautious about committing too much of their portfolio to these products? Could the promise of stability justify the trade-offs in flexibility? Or might sticking with growth-focused investments better serve your long-term goals? Share your thoughts, agree or disagree, in the comments below. This is one retirement strategy that sparks strong opinions, and your perspective matters.